I'm going to do a quick update before the employment report tomorrow. Um, Normally, I would have assumed that stocks would drop into the daily cycle low and bottom on the employment report because it should obviously be a horrible number tomorrow. And generally, I would expect the market would discount that and then it would bottom and do the opposite of what most retail traders um, and many analysts would expect. They would think that a bad employment report would cause the market to continue down. But if the market discounts that ahead of time, then the end result would typically be that it would do the opposite, and it would the daily cycle decline would bottom on that number, and then start the second daily cycle advance. But that doesn't appear to be happening. Um, I guess it could hmm, it could still continue down. The S&P hasn't actually made a higher high, so this could still be a move down into a daily cycle low if the market continues down tomorrow and we make a lower low below this. Then at that point, I would say um, we are completing the daily cycle low. But if I go over to the NASDAQ 100, we clearly are not moving down into a daily cycle low in the tech stocks. So, um, you know, a little up in the air right now. I don't really know what to say. I guess it is possible that a bad number tomorrow could trigger the market to start down into that daily cycle low. We're definitely in the timing band for it at this point. Um, we could also just continue higher, and the market could ignore that, and maybe we fill this gap on the Nasdaq, and maybe I've been kind of thinking that we would tag this 200-day moving average before starting down into the first daily cycle. So that's also a possibility. Um, my recommendation was just to put a stop underneath this pivot right here. And if the S&P goes below that, then that would be our confirmation that we are moving down into that daily cycle low. And then at that point, we would just try and spot the bottom and then buy, preferably on a swing, in preparation for the second daily cycle, which I think will definitely break, or at least tag this 200-day moving average, probably break it. I think there's a very strong possibility that the Nasdaq will definitely fill this gap before the intermediate cycle tops, and we may even test the all-time highs before this intermediate cycle tops. So moving on to gold. Um, this is kind of a pattern that's been in play now ever since the second phase of the bull market got underway in earnest. And by that, I mean a breakout above that 1370 resistance zone. Let me widen the chart. All right. So, once we finished this cup and handle bottom and then, started the second phase of the bull market. The first phase, of course, was the baby bull, and then we got that really long sideways basing pattern that finally broke out early, or I guess early summer of last year. We finally broke through that resistance zone at about 1370, and at that point we kind of started this pattern of we get this first leg of a intermediate rally, and then we get a period of sideways consolidation that runs for multiple weeks. And then we get a second leg up that tends to tack on about the same amount of points as the first leg. So kind of a T1 pattern, if you will. So that's what played out right here. Here's the midpoint consolidation. Kind of the same thing played out here. We had our first leg up. We had this sideways consolidation. And then we get the second leg up. Then we get another intermediate decline, and it looks to me like we're trying to form another one of these um, sideways consolidations. So there was risk yesterday that the banks might try and break this pattern, and well, you can see we're in a triangle consolidation. If the banks could break this and drive gold down, let's say below this pivot right here at about 13, just roughly 1370 or 1670ish, then they had the chance to break this pattern, this midpoint consolidation. But today the bulls came back, rescued the gold market, and so the consolidation is still intact. And barring another attack that is more successful, something that could break this lower trend line, I have to think that this is this pattern that has been in play now for the last year and a half is still in play. This is still a sideways consolidation after a first leg up. This leg tacked on roughly 350 points. So if we were to get a similar magnitude move during the second leg, we would be looking at possibly a test of 2000. And I've gone over this in more detail, what I need to see and in what timing band I need to see it and such in tonight's report for subscribers, the premium report. So if you want more detail, you'll just have to read the nightly report. But so far anyway, this is still following that pattern that has been intact since we started the second phase of gold's bull market. So the employment report tomorrow is a potential trigger event. It could possibly cause the S&P to continue down and finish its daily cycle low, or move the S&P up to test that 200-day moving average before we start down. And I think it's either going to be an opportunity for the banks to attack gold again and try again to break this pattern down, or if gold breaks through this upper trend line, then I would have to think that we're probably starting the second leg of this intermediate rally. And this also, I think, has connotations for silver. And again, I discussed that in depth in tonight's premium report.